Hi, Facebook world. Welcome to episode number 7 of the 39.6 Facebook live show. We're broadcasting live from from Montreal, Canada, in Old Montreal. Thank you. Hello. All right. And today we just had an exciting day of adventures. We wrapped up directly downstairs from our 1800s Airbnb is this place called Bar à Beurre. Fantastic macaron. We got an assortment of 6, and we kind of eat them one little bite at a time. Actually, one of them is completed, but we try to, Kate likes to enjoy every one a little bit of a flavor each time. And then they have this anniversary cookie, which is a butter cookie with icing in the middle, celebrating their anniversary with sprinkles. Welcome. A bunch of people are here. Hi to everybody. Yesterday I tried to do this, and then I waved to somebody, and then it reverted them to portrait. So I'm going to leave it here. I have a request for Kate and Shanola, I think, to come and say hi on the Facebook live stream. Shanola's fussing a little bit. Her 2 front teeth are popping out right now, so she's finally starting to teeth. And she's 1 year old. She's eating some sweet potato, and she's still enjoying her bib that says "time for cake" for her first birthday. Say hello, Shanola.
Hi.
Yeah. Okay. So, we are going to attack this question. I was kind of hesitant about doing this because, frankly, this is a super long one. I could easily spend over an hour on this topic. But this thread on the White Coat Investor Facebook group 2 nights ago, or was it just last night? I mean, it went like over 100 comments deep. So we are going to touch it today. I will probably come back. This is one of the most commonly asked questions, and that is, should you basically pay off a mortgage or invest? Okay, so here is the question. Hypothetical. I received a lump sum of $200,000, and I want to pay off my mortgage, which is also $200,000. Okay, so this post has 2 options. Option number 1, use the $200,000 and pay off the balance in full and become completely debt-free. Okay, that's a very simple option. Just wipe away the debt. And option number 2 is throw the $200,000 and invest it, and he's very specific with this, into a 70-30 stock to bond mixture, okay, assuming 5% annual return, and draw down the monthly mortgage payment every month from that account automatically through a service like Betterment. Okay, so 2 options. 1, pay it off, and the second one is invest it and then have that pool of money pay the mortgage every month. Okay, and in that option 2, the person assumes that there will be a 5% annual return. Okay, now, there's a lot going on here that I really need clarified, and I made a post with questions but never actually got responses. In the thread, the person clarifies that it is on a 10-year mortgage with a very low interest rate, only 2.875%. The person plans to retire in about 25 years. Okay, so first of all, my question is, where did the money come from? Who just stumbles on $200,000? The post also says hypothetical initially. So this probably isn't real, but so much commentary on this one question. So first, where is the money coming from? Okay, if the money came from the sale, I'm sorry, Shanola's crying. If the sale comes from the sale of if the money comes from a sale of a house, you might have to pay capital gains tax. If it came to you as an inheritance, well, there's probably no tax for you. Okay, she's being really loud. She almost never cries, and we usually do this after she's in bed. Okay. All right, there. So first of all, where's it from? Okay, do you have any tax liability? If there's tax liability, the question is completely different because you can no longer pay off the entire balance with this lump sum. Okay, and then my second question is this really is this an actual question or is this like a planted question just to stir up conversation? That was a little bit of a joke. Number 3 was, do you really only have a $200,000 mortgage balance? This is coming from a physician Facebook group, and most physicians don't have mortgages of $200,000, at least not when they're attending level and have an attending house. Certainly in residency, that's definitely pretty common. Hello to Shannon. I should say hi to people as you're walking in. Okay, so first I want to know if the balance really is $200,000. Okay, a lot of times people make posts on Facebook groups and then they change all the information because they don't want to make it real. But then the question is completely different. Okay, because at $200,000, you're not going to possibly have a mortgage interest deduction. But if it's $500,000 or more, then the mortgage interest deduction certainly comes into play. Okay, so these are two completely different scenarios. Even though the person who's making the post may just want to do a hypothetical, the actual numbers are very valuable. Okay, so I often in my responses ask for more information. And it's not because I want to know all of your financial information, but it's because I want to be able to give a good answer. Okay, then I also ask, how long do you actually plan to live in the house? If you're going to be moving out of this house in a year or two, does it really make that much of a difference if you pay it off, if you're just going to sell it? Or if you're going to move out of it and rent it out, do you really want to have a rental property that's debt-free? So just what is your long-term plan on the property? Should always be thought of in context. Okay, and I also mentioned so please confirm that you're filling up all of your pre-tax investment options, such as a pre-tax 401k, 403b, 457b, that you may have available with your employer. Okay, and that you also have an adequate emergency fund if you want to have one, and you have adequate insurance like disability, life insurance, etc. That we're crossing off all these bases because it's one thing to pay off a debt, but if you have all these other big liabilities that you're not protecting, well, it doesn't really make that much sense to do that first. Okay, so now to actually answer the question. Okay, so option number 1, paying off a balance of $200,000. Now, a lot of people know from my posts that I'm not afraid of having some leverage. I am a real estate guy. I like having mortgages so that the interest on the mortgage and the depreciation on the property wipe away my tax liability. Okay, and that's about being tax efficient. I don't necessarily condone being over leveraged, but certainly I think a moderate amount of leverage is very reasonable. Okay, now we always have to make answer the question, if you have the option of paying off your house, would you be willing, if it were already paid off, to take a home equity line of credit from that house to invest elsewhere? If you don't want to ever consider doing that, well, let's flip the situation around and you probably don't want to have your house have that mortgage, okay? Now, what's very important here is that the question is very clearly stating being debt-free and paying the balance completely off. Now, this is very, very, very different from having the option of taking $200,000 and paying down your mortgage of, let's say, $500,000. If you had a $500,000 mortgage and you just paid $200,000 off the principal, your next month payment is still exactly the same. All you do is move the timeline up of how long it will take to pay it off. Yeah, you get that equity, okay, but you still have the same cash flow issue from the property, and now you have less liquidity. Now, liquidity is one of the most important things in all of finance and is one of the most disregarded things in all of these groups that I'm in. The value of liquidity is substantial. If you utilize that money and pay off half of your mortgage, that money is not as liquid as it was before. If you had bought your property with $0 down and you put $200,000 into it on $1 million house, now you may only have 20% equity, and you can't get any of that out with a home equity line of credit because they'll only lend to you above 20%. So if you put that $200,000 in there and you can't get to it, you have decreased your liquidity and you have not decreased your cash flow. So it puts you actually in a less financially secure position. I'm not promoting, hey, go buy 4 Birkin bags because you could possibly do that with $200,000. I'm saying that when you make that choice to pay down a mortgage, it's not necessarily the most financially secure thing to do if you don't have other liquidity to protect you in the setting of losing your job, or you and your spouse both losing your jobs. If you can't support that cash flow necessity from that mortgage, then I would not throw all that money into paying a mortgage down. But paying a mortgage off, well, once you pay it off, you have an immediate increase in your cash flow. Your debt to income ratio on a month-to-month balance is much lower. This puts you in a much safer financial situation. You're not on the hamster wheel trying to make money to pay money, okay? So paying off a mortgage is actually a very, very, very reasonable thing to do, especially if it's a higher interest rate. But even at a lower interest rate, it's very reasonable. And if you're not having a tax deduction, you can't even utilize that as a rationale to keep it, okay? So paying off a mortgage is a very reasonable thing to do. And for a lot of people, I would advocate it because a lot of people just don't know how to manage their money outside of paying down the debt, okay? Now, option number 2, I'm just going to say absolutely do not ever even think about this strategy. This is a failing strategy. Putting $200,000 into a 70-30 stock bond mix, assuming a 5% annual return, and draw down the monthly mortgage payment from there. Okay, the problem is you are only investing the exact $200,000. This 70-30 mix is going to go up and down, and it may average 5%, but if you are drawing down from it every month, you have a very high risk of depleting. Now, later on in the post, the person says the interest rate is 2.875 with a 10-year note. Okay, so I put this into an amortization calculator, and the monthly payment on this is $2,880. Okay, well, $2,880, that's a big monthly payment, okay, on a $200,000 mortgage. $2,880 per month ends up being $34,560 per year as the monthly mortgage payment, okay? Now, if you look at the different data that looks on drawdowns of sustainable withdrawal rates, the 4% rule comes from the initial analysis by Bengen, then by the Trinity study, that showed that throughout history, if you had a reasonable stock bond mix of at least about 50% stocks, that if you drew down 4% of the balance every year and adjusted that for inflation, going up a little bit every year, that you had a very, very, very high likelihood of it lasting you at least 30 years, okay? But this person is suggesting taking out $34,560 out of a $200,000 initial investment on an annual basis. Okay, so that's actually a 17% drawdown. Okay, that is a huge drawdown. If you're taking out more than 10% from an investment account in any given year, if you take that 10% out just after the value has gone down by 50%, well, you're now taking actually 20% of that residual balance. So you have a very high likelihood of making that go down to zero and not lasting you the full 10 years. Okay, so if you want to make money into an investment pot to sustain the payments, you need to have a lot more than $200,000. Especially with a 10-year mortgage. Gosh, if this was a 30-year mortgage, the payment would only be about $1,000 a month or $12,000 a year. That would be a 6% withdrawal rate, and that would have a reasonable chance of surviving, okay? But if you really wanted to make it last, put $300,000 in there, okay, on a 30-year mortgage. That way your $12,000 a year of your payments is only 4%, okay? Now, one of the problems also with taking the money out of your taxable account every month to pay it off is that you're going to be selling funds on a monthly basis. So you will have funds that are sold at a short-term capital gain. So that will make your investments much less tax efficient. And if it's not as tax efficient, you're actually decreasing your actual returns. You in general I need to plug my computer in. Sorry. You in general never want to sell off short-term capital gains from your investment account if you're already at high income, Okay, short-term capital gains are taxed at your ordinary tax bracket, at your top marginal rate. So you never want to harvest or sell short-term capital gains unless you have a really good reason. So you should really only be selling things that are only long-term capital gains or at losses, which means you would need to have the money sit there for a year's time so you can have long-term capital gains. Now, Shinola is now 1 year and 3 days, and 2 days ago, she was 1 year and 1 day, so we celebrated long-term capital gains day. That's 1 day after 1 year. She will never have another long-term capital gains day, okay? So once you hit 1 year and a day on any of your investment accounts that are inside of a taxable brokerage, not inside of a sheltered account from your retirement or a 529, once you get the 1 year and 1 day point, any stocks that are sold so that you can take the cash and pay something will be taxed at long-term capital gains rate. So that would be 0%, 15%, or 23.8%. It just depends what your income is that year, okay? But certainly I would not want to harvest any short-term capital gains. Now, having a bucket from which the mortgage is paid is not an unreasonable idea. And actually, I love the idea, especially for people starting out, because they don't have any liquidity. They don't have any money, okay? Having that liquidity is what's going to prevent you from getting foreclosed if you have a loss of job or jobs and you can't make your payments. If you have student loan payments and a mortgage, $10,000 a month across these two things, and you're used to making $25,000 a month, you lose your job, well, you could be in trouble very, very, very fast. Having $200,000 liquid will save you from having to go through foreclosure and lose all of that money that you've already poured into these assets, okay? So, if you were to have a payoff bucket, the ideal situation would be something that has no risk of principal loss. So that would be something like a CD, a certificate of deposit, something that's like insured, FDIC insured, like a savings account, that had an interest rate that equaled, after taxes, that equaled the effective mortgage rate that you're paying on the property. So this person's paying 2.875%. Okay, now if this person is at a 25% tax bracket, he would need to earn basically like 25% extra on top of that in order to equal the 2.875. Okay, so let's pretend that person needs to earn 3.5% interest on the money that's on the investment bucket in the mortgage payoff bucket. So that bucket needs to earn 3.5% and not have any risk of principal loss. Well, unfortunately, that account does not exist, okay? At least not without limitations. So if you did a high yield savings account, you might be able to get 2% interest, okay? Now you'd have to take off your 25% tax bracket and you'd be paying you'd get 1.5%. So you would not be able to keep up with your mortgage interest, okay? You could put it into a CD and still be in that range, 1 to 2%. Okay, so there is no such thing as a bucket that will be, or an investment vehicle that has no risk of principal loss and will give you the same effective earnings, effective interest that equals your effective interest on the mortgage. Okay, because mortgages are always going to be higher risk than a CD, so there always has to be a delta between those two numbers. Okay, that's like the risk premium that the person who is giving you the mortgage, they're taking that risk to get that extra return. Okay, so, but if that bucket did exist, if you were able to have an investment that was secured from principal loss, from loss of value, okay, and earn enough interest to pay off the interest on the mortgage, then by all means, use that bucket, fill it up with the $200,000, and take away the $10,000 a month that this person needs to pay the mortgage, and that way the person is still going to have the same payment out of pocket to pay this down, but have the liquidity, okay? But that's just not possible. So ultimately, only one of these two options a person gives is actually a good option. I would not do a 70-30 with only the $200,000. Paying off the mortgage works. Now, the person is going to still be earning money. The person is not retiring for 25 years. So it's very reasonable to, yes, invest the money into whatever the investment allocation the person wants in their taxable account, and just cash flow the mortgage, okay? Because you don't want to be taking cash out of the taxable brokerage account to pay off a monthly expense because of the capital gains issue, okay? So as long as the person's earning cash from the job, that cash flow can go into the checking account and pay the mortgage, and then you can just have that money invested. Effectively, it's the exact same thing as the money coming out of the brokerage, but instead it's coming out of checking. Because if they were coming out of the brokerage, well, what are you going to do with that money that you're earning from your job? You should be investing that money anyway. So it would be going into the taxable brokerage account, okay? So between the two options a person gives, definitely only option one is really a reasonable, good financial decision. But somewhere in the middle of just investing the money, not paying it from there and paying out of cash flow is a very reasonable option. And that's what we do. We invest our money the way we want to invest it. Okay, so if you haven't ever thought of or written down an investment, an IPS, you should make your own investment policy statement of how you deal with money. Okay, how you deal with new money, how you deal with your cash flow, how you invest it. So that you don't have to make these decisions every single time you get a new bolus of cash. Because basically every single time you get paid, you'd be making decisions over and over again. You really need to have a system in place for the long haul. A good strategy will be successful no matter what the market does, but not having a strategy is a very good way to fail no matter how much money you make and no matter how well the market does. Okay? So come up with your plan. I'm perfectly fine not paying off our debts right now until we're financially independent. So what we're trying to do is take our cash flow, we invest about 80% of this every month, sometimes like 90% of it, and we invest it the way we want to. We max out all of our pre-tax buckets, we do the backdoor Roth IRA, and then the vast majority of it goes into taxable investing, which is almost 100% all in real estate syndications. That generates passive cash flow, that's tax-free cash flow, so it's very, very, very tax efficient, okay? Now, when we are financially independent and our investments are able to sustain all of our expenses and liabilities, including our student loans and mortgages, etc., then by all means, it's very reasonable to take extra money at that point and then pay off your liabilities so that, well, you don't have to have that liability column. But until we're financially independent, it doesn't really matter to us if we have debt or not, because it's not like I can stop working. Right? I'm going to have to continue working no matter what. So I might as well do the most efficient path until I don't have to work. And then if I don't have to work, then yeah, free up the cash flow. By all means, free up the cash flow. So there you have it. $200,000, pay off the mortgage, or $200,000 and invest it. With this particular option, the way it's phrased, I would pay off the mortgage. Okay, and we can go about this particular topic ad nauseum. It comes up over and over and over and over again. I'm so happy to see so many different people show up. This will be saved here on my Facebook page, and it will get posted onto the 39.6.com website, my blog. Please subscribe there. You'll get updates when I send them, and you'll be able to access all of the videos that I've done so far. And until hopefully tomorrow, remember, worry about what you can do, what your money can do for you, so that you don't have to work for your money. Peace out from Montreal.